Hello everyone, welcome to the Firm Returns podcast. This is episode 2, so I can officially call it a podcast series. Right, so today I'm going to have a look at, I'm going to go through the write-up I did on Somero Enterprises, so quite different to, about as different as you can get to the previous podcast I've done, which was on Warner Brothers Discovery this time, which was a company with a market cap somewhere around the $40 billion mark. This one's now a company with a market cap around the sort of $250 million point, so very much a micro cap. Let's just go through the overview I've got here for the company. So Somero Enterprises Inc. is a US industrial company manufacturing equipment for concrete leveling, contouring and placing. It has been listed on the alternative investment market, also known as AIM, of the London Stock Exchange since 2006 and currently has 55.8 million shares outstanding, trading for a combined market capitalisation of circa £204 million, which, like I said, is about $250 million at current conversion rate. Their history is encapsulated concisely in this excerpt from the AIM admission document. So this is the admission document from back in 2006, and it reads this little excerpt reads as follows. Somero was founded by members of the Somero family in 1986. Who would have guessed? The year in which it introduced the first model of the laser screed. In 1997, Summit Partners invested in Somero and brought in a new management team led by Somero's current president and chief executive officer, Mr. John T., also known as Jack Cooney. Somero was subsequently sold to Dover Corporation in 1999. In 2005, an affiliate of the Gores Group, a private equity company based in Los Angeles, California, acquired Somero from Dover Corporation. So I've made a little note here as well, saying it should be noted that Jack Cooney stepped down as president of the company in 2021, but remains CEO. So we'll cover the management in more detail later on. Let's just have a look through the products that they offer. So the company pioneered the laser screed technology that enables efficient and precise concrete leveling. The wide range of products developed and sold by Somero allow this technology to be deployed in almost all construction settings, whether this be large-scale projects such as warehouses or public infrastructure, small-scale residential developments or high-rise buildings. As illustrated in the first chart below, so we've got a chart here showing revenue by product line, units by product line, and revenue per unit by product line. So this sort of combination of the two. So as illustrated by the first chart below, boomed and ride-on screeds are the company's largest revenue generators, with boomed screeds standing out by a wide margin. In terms of units sold, the picture is a little more balanced across product lines. Boomed and ride-on screeds and Somero Line Dragon units volumes are all comparable. So I'll give you the figures in a minute, but to finish this off, much of the difference in revenue is explained by the third chart, which shows the average revenue per unit by product line. This substantially higher value per unit of the boom screeds widens the gap in revenue versus units sold. So the first graph is the revenue by product line, second graph is units by product line, and the third graph is effectively the first graph divided by the second graph to give you the revenue per unit by product line, so you can just get an idea of how much they sell each individual unit for. So just to give you the figures here, the boom screeds brought in net sales of, in 2021, $65.4 million, which was a pretty massive increase on the previous year of 31.7. Obviously 2020 being a big year of a large part of the pandemic, and a lot of projects and so on, I imagine, would have been put on hold. And then the next, in terms of revenue generation, the next one down is ride-on screeds, which produced $21.3 million. They produced that in 2021. And in 2020, they produced $17.6 million. So it's quite a big difference. So in 2020, it was about just over half of what the boom screeds were doing, but now it's sort of less than a third. So as we'll see with the next graph showing the units sold, a lot of this comes down to the fact that the value of the boom screeds, which are the much larger, meatier machines, are significantly higher per unit than the ride-on ones, which are smaller, obviously aren't designed to do such big projects, sort of indoors quite often, versus the boom screeds, which might be big outdoor projects, doing an airfield or a big car parking structure or something like that, a big outdoor area that needs smoothing over. So in terms of units sold, with the boom screeds, it was 218 units in 2020 versus 125 in 2021 versus 125 in 2020. So quite a big jump up, but not as much as the revenue, which implies that there's been an increase in price per unit sold as well. And then the ride-on screeds, rather than being just a third like they were in terms of revenue, are pretty close. They're 181 versus, and it was 157 in 2020 as well. So in both years, pretty comparable levels to the 218. In fact, in 2020, they sold more units than the boom screeds. 157 ride-ons sold versus 125 boomed. And then, as I mentioned as well, the Somero Line Dragon, which is another of their products, sold 132 units in 2020 and actually had a bit of a decrease in 2021, down to 110, but still all of them quite comparable. So yeah, then we move on to the revenue per unit by product line. So we can see, just to give you an idea, the boom screeds in 2021 were selling for about $300,000 each versus $254,000 in 2020. Ride-on screeds in 2021 were selling for about $118,000 versus $112,000 in 2020. They have a category called remanufactured machines, which is effectively refurbished machines, and they're usually some of the big boom screeds, I would imagine, from these prices. So it's 185 in 2021 and 157. So I imagine they're older boom screeds that have been used in prior projects now getting refurbished and resold to people who don't want to pay for the latest model. And then the Somero Line Dragon, just to give you a comparison, is much less, 38,000 per unit in 2021 and 36 in 2020. Another one that's quite high and comparable, but they only sold 3 units in both 2021 and 2020, which is one of their new products, which is the Sky Screed. So this sells for, in 2020 they sold it for 333,000, and in 2021 they'd reduced the average price down to 300,000. So it's very comparable to the boom screed. Now this is one that it's a screed, with a big arm for smoothing over, but it sits on top of skyscrapers basically for smoothing over and doing the whole roof area on top of a tower block, for instance, as it's being built. So it's much more like a kind of a crane in appearance. I recommend having a look. Somero actually has a YouTube channel, and they have videos. You can see all of these different machines in action to get like an actual picture of what they look like. And I think I might have shared some of these videos on Twitter at various points as well. The Somero Line Dragon is basically it's a concrete placement machine. So it has a big hose, and it's remote controlled, and it can be driven out into the concrete to place the thing. And this is, if you imagine people physically doing this, when you're carrying a hose full of liquid concrete, it must weigh an absolute ton. So there's apparently a lot of back injuries and stuff like that. They read some of the testimonials with some of the construction companies that use it, and they're talking about how just it's worth its value just in terms of the reduction in back injuries and medical claims they've had to file out. So that Somero Line Dragon, as we'll find out later on, actually was something that they acquired through an acquisition as well. It was obviously it didn't used to be called Somero Line Dragon; it used to just be called the Line Dragon. So that's something they've purchased. Right, so let's just carry on reading. So many of the product lines are complementary to each other. For example, the 3D profiler system can be combined with most of the laser screed models to allow accurate paving of contoured surfaces. Similarly, the Somero Line Dragon, a product acquired in 2019, as I said, can be combined with smaller laser screed models for rapid and precise concrete placing and leveling. A newly released product, Broom and Cure, is also designed to work in concrete with the boom screed models to brush and cure the concrete immediately after it has been leveled. So there's a good video of that as well on the YouTube channel, showing you the boom screed going in, smoothing the concrete, and then it being following right behind it. You've got this broom and cure machine that looks very, very similar, with a big arm that goes out and it just smooths the concrete and sprays the curing mixture. I think it might just be water, but I'm not an expert, so I can't tell you. But this is something that in other videos you see is a very manual job. They've got these guys doing the brooming with these absolutely massive, long, bit like when you see window cleaning of really high buildings and stuff. It's that kind of thing, with a bit of quite a wide thing, but it's obviously limited by what the kind of weight they can actually hold. Whereas obviously if you've got this in a big mechanical arm, it can have a much wider broom and be much more efficient. But obviously it's a much bigger, more costly machine. But there's obviously some value there, and it's a product they've brought out. So let's have a look at, as you would expect, many of the technologies the company's developed are protected by patents. They currently have 90 patents either in place or pending, and continue to invest in new product research and development. Yes, this was quite impressive, and when I looked at some of their competitors, Somero already stands out as the largest patent holders in the industry, and I think I mentioned that later on when we talk about some of their competitors. So, geographic distribution. The company's global headquarters is in Fort Myers, Florida, and its main production facility is based in, I think I want to say Halton, Michigan. Maybe someone who's comes from Michigan and knows that name can correct me. It also has regional sales and service offices in the UK, India, Australia, and China. The Halton facility has been undergoing a $9.5 million, 50,000 square foot expansion, which will increase its production capacity by 35%. This was on track for completion by year-end 2022 and on budget as of their latest trading update. So I can confirm later on they confirmed that it was completed and on budget. The expansion will facilitate production volume to support $175 million in revenue, creating capacity for growth from the $133.3 million of revenue generated in 2021 and the $138.8 million estimated for 2022. So after I've gone through this, I'll update you on what their latest figures were and whether they met these estimates. North America is the company's largest market, making up 80% of sales in 2021. This is followed by Europe at 9.1%, Australia at 4.6%, China at 2.0%, and the rest of the world contributing a combined 4.4%. So I've got a little graph here showing those regional sales. And North America can be shown in 2021 produced $106.6 million in sales, and that was up from $70.7 million in sales the previous year. Europe, the next highest, at $12.1 million in 2021 and $8.6 million in 2020. Australia then at 6.1 in 2020, and this is a pretty phenomenal increase from the $1.1 million they did in 2020, and this is, as I'm going to explain, due to the fairly recent establishment of the sale of a new sales office and team in Australia. So this is why, on the relative basis, Europe and Australia in particular, are showing the greatest year-over-year growth in their region. China, it was $2.7 million in 2021, and it was just down from 3.9 in 2020, and this is the only region to have had a decrease between those 2 years. We'll get a little bit into that later on. And the rest of the world combined did $5.8 million, which is an increase on the $4.3 million achieved in 2020. The European and Australian sales and service offices were established fairly recently, with the European office the older of the two. The investment made in these regional sales and service teams is starting to show in the revenue growth, with the Australian growth particularly standing out, though from a lower base. That's what I was mentioning. Due to a lack of demand for its products in China, the company is scaling back its operations there, meaning sales in the country are likely to grow in the near to medium term. So something I quite like here is that once they have realized that a certain region, in this case China, is not really going to be particularly conducive to sales, they've been quite quick to pivot, and so we're not ploughing loads of money into it and wasting that capital. We're just trying it out. They put in small operations there. They had a training facility set up, but they're not falling to the sunk cost fallacy or anything, and they've been quite quick to pivot away from it and wait until it's an attractive area again. I think the reasons they gave for China not being an area that's going to work is, I think, the perhaps regulatory stuff in the country, it's not been particularly positive towards them as a foreign company trying to sell in China. Also, I think part of that is also to do with there's a local competitor that really only has quite basic range, nothing to match some of the bigger screed models and higher tech stuff that they've got, but they do have some basic leveling, laser screed leveling technology, and so I think China is trying to protect that company by preventing some of that. That bit's speculation, but I would imagine it's something along those lines. And I'm not entirely sure that, even though there is that company being started there, so obviously there are people in China who believe there is value in it. I think generally the construction industry hasn't perhaps appreciated the value of the laser screed technology and how it can improve the benefits of it can have on the efficiency of a warehouse's operation afterwards, reducing wear on equipment, forklift trucks driving around, and just generally improving the precision of things afterwards, and the speed of which you can achieve these results. So I don't think that's quite been appreciated in China yet, and I don't think there's not really the market for it at the moment. So they've pivoted away. So let's have a quick sip. I realised in the last podcast, because I wasn't taking any drinks, my lips were smacking a bit, which I'm sure was quite annoying to anybody listening to it. So I'll try and keep my mouth moist so you don't get that experience this time. So let's move on to have a look at the customers. So Somero's main customer, the concrete contractors, which use its products in a wide array of construction projects. This has included work for a plethora of the world's largest organizations, such as, I just want to say I do love the word plethora. So a plethora of the world's largest organizations, such as Costco, Walmart, Home Depot, or Home Depot. I'm not sure which way. I think Home Depot is perhaps how we would say it, but Home Depot is the American saying. And it is an American company, so Home Depot will go with. B&Q, IKEA, Coca-Cola, FedEx, and Tesla. So quite an impressive array of big blue chip companies there that they can call customers via concrete contractors that are actually using the machines to do work for these companies. And there's also an awful lot of, their machines are used for an awful lot of sort of public sector work as well, prisons, schools, hospitals, all that kind of stuff. So yeah, it's quite a diverse number of use cases in there. The company endeavours to build up long-standing customer relationships, which leads to repeat business and ongoing revenue from after-sales services like product training and servicing and repair. It also manufactures refurbishes older machines, which it resells to more financially constrained customers at lower prices than the new models. So this is what we saw earlier with the remanufactured machines selling for around about half the price of the new ones. So it means they get some resale value, and I think the actual profit margin on those is pretty phenomenal because they don't have to do too much work to get them into shape, and they're able to resell them on. Due to the size of some of Somero's customers, there is an element of concentration to revenues in any given period. For example, at 31st of December 2021, the company had 2 customers which represented 21% of total accounts receivable. Similarly, at 30th of June 2022, the company had 2 customers which represented 20% of total accounts receivable. Geographic expansion is likely to reduce this concentration going forward. So yeah, I think a large part of this is going to be to the nature of some of the size of some of the concrete contractors in America, and I'm sure that there are some that operate over multiple states, for instance, so or are involved to get large contracts for various different nationwide companies, as we've mentioned before. So I think, yeah, there's going to be just an element of concentration just because of the concentration in the concrete contractor industry. But with the geographic expansion into other regions, I think that's naturally going to decrease some of the concentration. It's still not too bad. So top 2 customers representing sort of 20% is of the account receivable is not too bad. And like I say, these are pretty big, reputable contractors doing contracts for big blue chip companies and government contracts and so on. So their insolvency risk is probably pretty low anyway. So let's have a look at competition. So Somero is the largest and oldest manufacturer of laser screed leveling machines, having pioneered the technology in 1986. Its closest competitor is Ligchine. Let's call it Ligchine, another US company founded in 2007, which offers a range of boomed screed machines with their own laser guided technology. They also make one drive-in model, which is comparable to the ride-on range from Somero, and a concrete placement machine, which is a competitor to the Somero Line Dragon. In terms of scale, Ligchine has a much smaller product offering than Somero, illustrated by the 6 patents it has in place and 8 pending compared to Somero's 90. So that's what I was saying earlier. I found a UK-based concrete contractor which uses a Ligchine boomed screed alongside a range of boomed and ride-on models from Somero. This demonstrates that they also have a international presence and can compete with Somero in certain product categories. In this case, it was a mid-sized remote-controlled machine, which is not something Somero currently offers. So this was interesting, yeah. But the big Somero boom screeds, they always have an operator sitting on them, whereas with the sort of big boom screeds that were offered by Lichine, which seemed fairly comparable in size, maybe not quite as big as some of the biggest Somero models. But what was interesting was that there was a guy standing away from it with a remote control unit operating it. So didn't actually have to have a guy sitting on it. And I'm not sure whether that's still a comparable size, so I'm not sure whether that's an advantage or not. But that's just something to bear in mind. There is a potential thing offering there that Lichine provides that Somero doesn't. Maybe something they'll develop if there is a requirement for it, a demand for it. The other competitor I found is Hiking Laser Screed, and this is the Chinese company I was alluding to when talking about China. So Hiking Laser Screed, a Chinese company that makes a range of ride-on and walk-behind laser screed machines in the 20k to 50k price bracket. As far as I can tell, they predominantly sell their products in China and were possibly a contributing factor to the lack of demand for Somero's products in the country. As I was saying earlier, I don't see them as a major competitor to Somero at this time due to their product offering being entirely at the lower end of Somero's range and the lack of international presence. It also appears that much of the technology is not proprietary, and they import a lot of their key components from the manufacturers in Germany and other countries. I don't think they can compete with Somero from a technical standpoint. However, their factory footprint is significant and would likely facilitate substantial sales growth in the future. So if you have a look on their website and you see some of their videos and stuff, you can see I've got a pretty massive factory facility set up there. So there's plenty of room for growth there if they do need to expand. Somero's proprietary technology and commitment to continued R&D, along with its long-standing relationships with major concrete contractors and international scale, provide it with a substantial moat and large margins. The risk is that the profitability of the business will attract more competition to the market that will subsequently shrink the company's margins. Given the competitive advantages of the company and its relatively small market capitalization, I see it as more likely that a larger company would acquire Somero rather than try to compete directly. That was an interesting thing. So maybe you could see some large, given that it's just a £200 million market cap, $250 million, you could see some large competitor, well, some large machine company. There's plenty that have got in the multi-billions of dollars that could come along and decide this was something they wanted to acquire, much like you sort of saw in some of Somero's earlier history when it was being picked up by private equity companies and so on. So I think companies of this size definitely can be considered targets for this kind of thing, whether it's from a company in the space making these kind of machines, or a private equity wanted to do a leverage buyout or something. They probably wouldn't need much leverage for $200 million or $250 million. And yeah, I think when I looked it up, I think Dover Corporation is actually might be getting this wrong, but I think it was a fairly large machine company, the multi-billion dollars. And I think I mentioned that a little bit later on when talking about management, because some of the management have some links to Dover. Right, so let's have a look at the ownership of the company. So there is no controlling shareholder with majority ownership of the company, and the top 10 largest positions are all comfortably below 10%, as shown in the table below. In terms of internal ownership, the largest shareholder by far is the company's CEO, Jack Cooney, who holds around about 1%. So we have a list here of some of the top holders of this company. So Hargreaves Lansdown, Close Brothers Asset Management, Interactive Investor, Unicorn Asset Management, Aberdeen Standard Investments, Chelverton Asset Management, Schroeder Investment Management, Canaccord, Genuity Wealth Management, Societe Generale, and AJ Bell. And I've made a little note underneath saying, I could be wrong, but I believe the stockbrokers listed, e.g. Hargreaves Lansdown, Interactive Investor, and AJ Bell, actually represent the conglomeration of individual investor accounts. So yeah, I could be wrong with that, but that would make sense. But these figures did come from the company's, I believe, the company's website. So yeah, I'm not sure the metrics they use for categorizing their largest shareholders. Capital allocation. So this is the quite an interesting and important bit. The company executive team strikes a healthy balance between investing for the growth of the business and returning capital to shareholders. Examples of investments made include the $9.5 million expansion of the Horton production facility, the establishment and build-out of the in-country sales and service teams in an increasing number of geographies, and the acquisition of the business assets of Line Dragon LLC. So that was obviously what became Somero Line Dragon. In terms of capital returns, the primary medium is through dividends. The company pays regular final and interim dividends, which most recently came to 22.02 cents and 10 cents per share, respectively. In addition, the company has started paying a supplementary dividend which amounted to 19.70 cents for financial year 2021. The supplementary dividend is set according to a policy of paying 50% of the excess of net cash over the year-end target. In 2021, this target was $20 million, but for 2022 it will be raised to $25 million to reflect the growth of the business. Overall, dividends paid in 2022 totaled 51.72 cents, equating to a yield of circa 11.6% on the stock price of £3.70 or $4.46. So it's worth noting, I think this is more like £4.20 now. So it has that yield. Relative yield has come down a little bit as the stock price has appreciated a little. In addition to dividends, the company also does share buybacks. Currently, these are just being used to offset stock-based compensation and prevent shareholder dilution. Stock-based compensation is currently running at around 1 to 2% a year, so a similar quantity of shares are being repurchased on an annual basis. So we'll have a little drink. Right, so let's have a look at the balance sheet. The company has a very robust balance sheet with a current ratio of 3.79, asset ratio of 3, and net cash after subtracting lease liabilities of $37.9 million at year-end 2021, the last audited financial statements. So just remember with that cash figure that the market cap is only around about 250 or closer to maybe $300 million, so quite a big chunk of cash there. These figures decreased somewhat in half one 2022 to 3.22 for the current ratio, 2.13 for the asset ratio, and $23.4 million for the net cash, following the payment of dividends and an increase in inventory. So you'd expect these to come up towards the end of the year, as by the time you get round to the same point at which the previous figures on the year-end balance sheet were reported. So as of year-end 2021, Somero's current assets made up the majority of its total assets, $68.1 million of $97.4 million. And most of this was cash and cash equivalents, $42.1 million. Inventories made up a further $14.3 million and receivables $7.7 million. At the end of H1 2022, cash and cash equivalents had fallen to $27.2 million following the dividend payment made in May. Receivables had been reduced to $6.6 million owing to prompt customer payment, and inventory had increased substantially to $19.9 million. The majority of the company's non-current assets are made up of tangible assets within the category of property, plant and equipment, PP&E. At year-end 2021, PP&E was valued at $21.6 million, and at 30th of June 2022 it had increased to $23.2 million after continuing work on the Horton facility expansion was capitalized. Intangible assets, intellectual property, etc., and goodwill made up only a small portion of the company's overall assets. At 30th of June 2022, they were valued at $1.3 million and $3.3 million respectively. The goodwill present on the balance sheet is attributable to the company's prior sale of from Dover Corporation to the Gauze Group in 2005, and the later purchase of the Line Dragon LLC business assets in 2019. On the liability side of things, there is a similar picture. Current liabilities make up the vast majority of total liabilities, $18.3 million of $21.7 million as of 30th of June 2022. And of these, accounts payable and accrued expenses were the most significant at $7.4 million and $10.4 million respectively. Somero's debt interest is more than covered by the interest they receive on their cash deposits, so no need to worry about interest cover. So it's nice to hear about a company that, compared to Warner Bros. Discovery, for instance, that basically doesn't have any kind of leverage to worry about. The company has a $10 million line of credit with a maturity date of September 2024 and an interest rate of LIBOR, so I think that's London Interbank, something right, LIBOR plus 1.25%, which as yet remains undrawn. Subtracting the liabilities from the assets gives the shareholders' equity, which was $68.3 million as of 30th of June 2022, with a market capitalization of circa $249 million, so about $250 million, but as we say, it's slightly higher now. This gives a price to book value of 3.6. It's worth noting that this is calculated using the mid-year equity figure, and given management's year-end estimate for cash to be $39.9 million, we can reasonably expect this price to book ratio to be a little lower. So yeah, something just worth noting here with the price to book stuff is that, as you'll see later on when we start talking about margins and things and return on capital and return on equity, it goes well because of the things like the patents and the general technology they have, and their ability to compete with their competitors and the unique offering. They're able to make quite a bit more money than would be suggested by their book value. So it's a little bit like you see with some of the tech companies and stuff like that, in terms of their price to book being fairly meaningless compared to their sort of PE ratio or other sort of, or looking at the cash flows or other metrics. So yeah, but as we'll see, it's the company's trading pretty cheaply on all sorts of all kind of earning metrics. So let's have a look at the income now. As shown in the chart below, the company's revenues have grown quite substantially since listing, though with some cyclicality. There was some rapid growth in 2006 and 2007 before the 2008 financial crisis hit and depressed revenues from 2009 to 2011. Then from 2012 to 2018, there was an upward march which cooled off slightly in 2019 and then remained flat in 2020 as we entered the pandemic. 2021 saw a pretty dramatic increase, likely due to pent-up demand from 2020 that was pushed back a year, though this appears to be roughly the level you'd expect if 2019 and 2020 had followed the trend of the prior 8 years. Management has estimated that revenues for 2022 will come in at $138.8 million, and I'll give you the proper figure on this a bit later, suggesting the high revenue figure in 2021 wasn't just a one-off spike. So yeah, it's a bit of a roller coaster kind of graph. You've got a little peak after it listed. It then drops down because it obviously goes into the financial crisis, and I think perhaps their approach towards debt and other things was quite different at that time, and they were paying high debt interest at that time. And then they found religion and sorted out their balance sheet, and then you just got a really nice, smooth, pretty much straight line up all the way up to 2018 before it then kind of leveled off a bit in 2019 and 2020, and then sort of continued back up in 2021, pretty much following the straight line that was set from 2012 to 2018. So yeah, 2019, interesting to see that the year before the pandemic there was some kind of cooling off there, but yeah, it was a kind of abnormal for such a smooth growth curve to be shown anyway. Right, so let's move on. If we include the estimated figure for 2022, the average 5-year and 10-year revenue growth comes in at 11.72% and 16.96% respectively. Given the scope for international growth outside the company's main North American market, I think it's reasonable to expect revenue growth of around 10% or more to continue. Of course, there is the potential for revenues to take a hit if the economy enters a prolonged recession over the next couple of years. Rapid interest rate rises in response to double-digit inflation in much of the world is likely to have knock-on effects to the global economy that may depress demand for construction and, in turn, Somero's products. Much of the revenue increase in 2022 was attributable to inflation-driven price rises, rather than increased sales volumes. In fact, as mentioned earlier, units sold in H1 2022 fell relative to the year before, but we'll have to wait to see how things went in H2 for a full comparison. I think it would be inaccurate to attribute any slowdown in 2022 sales to general economic stagnation. Rather, it's more likely to be revenue returning from its previous growth trajectory after the demand carried over from 2020 into 2021 caused a dramatic spike. Net income paints a similar picture, though a little less smoothly, and with some notable negative figures between 2009 and 2011. The particularly large drop in 2009 was likely due to the write-off of inventory or other assets, as a similar fall was not seen in the operating income. I have limited data going back this far, so I'm only able to make an educated guess. So yeah, I've given a graph here showing the net income and operating income going all the way back to the time it was listed, and it follows a similar kind of curve, but the net income turns pretty negative in 2009, which and then sort of stays negative for 2 years after that, so 2010 and 2011. Only really and then just started turning profitable again in 2012, and then sort of shooting up and following the same kind of trajectory curve we saw before, but slightly more leverage because it's going from negative to positive. So let's have a look here. The company has maintained a consistently high gross profit margin over the last decade, averaging 55.1% over this period. The operating profit and net profit margins have shown impressive growth of 4.39% and 3.17% respectively in 2012 to in 2012 in 2012 to those are the profit margins to begin with, 4.39% and 3.17% in 2012, and then in 2021 they'd gone up to 33.86% and 26.12%, which is pretty phenomenal. The profit margin increases there in operating and net profits respectively. The change in these figures indicates a substantial improvement in operational efficiency, which I would attribute largely to operational leverage. Operating expenses have grown more slowly than revenues. So we can see I've listed these graphs here showing the gross margins are sort of gradually built, but you've seen a pretty rapid growth and then kind of leveling out of the operating and net income margins. But yeah, as we're going to see now, the star of the show in terms of metrics has to be return on equity. Last year the company achieved a pretty phenomenal 50.1%, and the average of the last 5 and 10 years has been 39.7% and 34.8% respectively. These figures highlight the quality of the business and the competitive advantages it holds in terms of brand and technology. So you can see a graph here showing the return on equity across the years from 2012 to 2021. We had a couple of years that were over 50, and then there's one over 42, and then the average, you can see quite a few over sort of 33 to 38 kind of range, and then as I said, the averages before were 39.7 for over 5 years and 34.8% over 10 years. So still just pretty crazy margins when you're thinking about this is an industrial company. So cash flows. In the year ended 31st of December 2021, cash flows from operations came to $36.9 million. This was not far from the net profit figure of $34.8 million, as positive adjustments for depreciation and amortization, stock-based compensation and increased payables balanced negative adjustments for increased inventories, increased receivables and decreased income taxes payable. The difference between the two figures in 2020 was much larger, with net profit coming to $18.8 million and cash flows from operations $30.6 million. The primary reason for this was the positive adjustment for reduced receivables and inventories and increased payables without any large negative adjustments to compensate. These are all moves you would expect management to make to maintain liquidity during a period of economic turbulence. So yeah, you'd expect them to collect as much money as they can from their receivables and sell down their inventories as much as they can and increase their payables, so delay payments to suppliers as much as possible if you're going to try and generate cash in an economically turbulent period as we saw in 2020. In the results for H1 2022, cash flows from operations decreased to $12.8 million from $16 million in H1 2021. This fall was quite a bit larger than that for the net profit figure. And we're given here H1 2022, net profit was $17.5 million, and H1 2021 it was $18.3 million, so much closer figures. And this can be attributed to a number of factors. Inventories increased by $5.7 million in H1 2022 versus $3.1 million in H1 2021, accounts payable, accrued expenses and other liabilities remained largely unchanged in H1 2022, while in H1 2021 they increased by $5.1 million. A decrease in receivables of $1.2 million in H1 2022 versus an increase of $2.8 million in H1 2021 was only partially offset the prior two factors. So yeah, I mean, for anybody who doesn't know, with these when you're reconciling net profit to cash flows from operations, things like increases in receivables are increases in, you have counter effects from increases in receivables and decreases and increases in payables and so on, depending on effectively just something like a decrease in inventories implies that you've sold that inventory and therefore generated cash, and same kind of thing if you increase receivables, and then you're assuming that you've sold more things but not received the cash for them, and if you decrease receivables, you've managed to get, receivables are the credit you've given out to your customers, and effectively when the receivables decrease, it's implying that the customers have paid you cash, so you're expecting your cash balance to have gone up. But in terms of sales, when you make a sale and you collect record a receivable, that counts towards the profit. And so this is why, so in terms of a profit basis, you could make all your sales for a year effectively in credit and not receive any cash for them and still have made a great net profit figure, but you haven't actually had any cash flows from operations for those. So yeah, it's all this kind of stuff is what's used to reconcile you down from the profit figures to the cash flows, for anybody who wanted to know. So in 2021, $6.2 million was invested in purchases of property and equipment, and this trend continued in H1 2022 with a further $2.3 million investment. These will both primarily be attributable to the $9.5 million being invested in the expansion of the Horton production facility. So, net cash used in financing activities amounted to $24.3 million in 2021, comprising largely of the $22.4 million in dividend payments and $1 million in share buybacks. In H1 2022, this had increased to $25.3 million, owing to the introduction of a supplementary dividend in addition to the final dividend for 2021. We know that a further interim dividend payment was made in H2 2022, amounting to $5.6 million, and share buybacks also continued in the second half of the year, and the total is expected to be comparable to 2021. So now I've got a graph of showing the net income, cash flow from operations and free cash flow, and there's a little description here. So zooming out to look at the broader picture of cash flows over time, we can see that cash flows from operations have generally moved in line with net profit, and in the majority of years exceeded it, meaning the cash conversion ratio has been greater than 1. And I've given the figures here. The 5 and 10 year cash conversion ratios averages are 1.16 and 1.4 respectively. So that's a positive thing from sort of business liquidity and cash generation, to see a business is generating more cash than it's actually recording in profits, or at least matching it. When studying the company's cash flows from a valuation perspective, the cash flows from operations with the optional subtraction of depreciation/amortization charges are probably the better figure to use, rather than free cash flows, which subtract capital expenditure on PP&E, such as this capex that will be attributable to growth rather than replacement. So yeah, they don't really give you a division of capex into growth and maintenance capex. So, but we know that a lot of the spending they've been doing recently, at least, has been growth capex, like the expansion of the production facility and putting in, new invest. And you think about, there's other figures I think that don't really show up here as well. Like, for instance, if you're expanding your sales team in other countries, you've made an investment there, and yet it's increased it will have actually decreased your gross profit margins, not gross, but your operating profit margins. But initially, and it will show up as higher expenses and so on. But that's effectively an investment you've made into expanding and growing sales in future years. So, and increasing your revenues in future years. So it's these kind of things aren't necessarily reflected in there. So it's but worth bearing these things in mind. So have another quick drink. So let's have a look at the company's management. The company's non-executive chairman is Lawrence Horsch, aged 87. Lawrence has been with the company since 2009 and has served on 26 company boards throughout his career, as well as investing in 30 venture projects and 4 corporate turnarounds. He also co-founded SciMed Systems, which was later merged with Boston Scientific Corporation. That sounds quite familiar to me, that one. I did actually have a look at it, but I can't exactly work out why I know it, but it's Boston Scientific Corporation. Definitely rings some bells. CEO and director John, aka Jack Cooney, aged 74, has served as CEO of Somero since 1997 and became an executive director in 2005. Prior to joining Somero, he was CEO of Advanced Machine Company, a $145 million industrial equipment manufacturer located in Minneapolis, Minnesota. I think the performance of the company over Jack's long tenure speaks to his aptitude as CEO. John Youngster, aged 51, not 81, joined Somero in 2015 as CFO, but has recently taken over the president role from Jack Cooney, and now serves as both company president and director. Previously, John Youngster was CFO of Datamax O'Neill, a subsidiary of Dover Corporation, which we know previously owned Somero. So that was one of the links I was mentioning earlier. The current CFO, also serving as secretary and director, is Enzo Licorsi. I think I'm pronouncing that right. Aged 48. Enzo joined Somero in 2018 as Vice President of Finance and Controller. He has previously held a number of finance and senior management roles in several well-known companies. So the final member of the executive team is Executive Vice President of Sales and Director Howard Hoffman, aged 59. Howard also joined Somero in 1997 and has nearly 3 decades of experience in the concrete industry. He is also an ex-Marine. The board has a further 3 non-executive directors, namely Ann Ellis, Thomas Anderson, and Robert Schur. So let's move on to probably the most crucial bit, maybe second most crucial compared to with risks. So valuation and investment case. Given how closely net profit, cash flows from operations and free cash flows have tracked one another over the last decade, I think it is reasonable to take your pick according to your personal preference. To be conservative, I like to use the 5-year average as the denominator in valuation ratios, as this allows for a potential downturn in the next few years. Using this approach, the PE, POCF and PFCF for price to earnings, price to operating cash flows and price to free cash flows ratios are 10.9, 9.6 and 10.9 respectively. So PE and PFCF basically the same, and then slightly lower for the price to operating cash flows. Using the results from 2021 rather than the 5-year average, the PE, POCF and PFCF ratios are 7.1, 6.7 and 8.1 respectively. So, as you'd expect, come down due to the growth. I feel these modest multiples combined with the strength of the balance sheet provide adequate downside protection. To the upside, if the company is able to keep growing earnings at somewhere between 5 and 10% a year from their current level, you could be looking at an internal rate of return in the range of 15 to 20% when calculated over a 20-year period. This focuses purely on the fundamentals and doesn't factor in any potential re-rating that could occur somewhere along the way, giving shareholders capital gains in excess of this range. At risk of making macroeconomic predictions, it is perhaps worth mentioning that the increased infrastructure spending being proposed by many governments around the world, and particularly the US, would likely serve as a tailwind to Somero. Concrete will serve as a crucial component in many infrastructure projects, and in most cases it will need to be levelled. Forecasting aside, the management of Somero has stated that many of its customers have significant project backlogs which provide some visibility for revenues in the coming year. I don't think it's particularly constructive to be too precise with a discounted cash flow DCF analysis, as accurately predicting growth rates is highly improbable, and it's easy to convince oneself that any investment is attractive with the right input parameters. Instead, it's better to position yourself with plenty of margin of safety and scope for substantial gains if the stars align. I feel Somero offers both these attributes at the current price of £3.70 or $4.46 per share. So like I say, it's come up a little bit since then, but still looks very attractive to me. Still a below 10 PE for a company that's got an average return on equity sort of well north of 30% over the last 5 and 10 years, and is only £200 million, a bit more now, and is growing at the rate it's been able to grow, and has a lot of scope. It's only really just touching the surface of what it could be doing internationally. It's largely still 80% of its revenues are derived from the US, so a lot of potential for, if you could see, maybe not the same size as the US, but if Europe and Australia and some of the Latin American markets of that start to grow up to be comparable sizes to the US market, you could see really massive growth in the company. I could see a path to it being $1 billion company in the future, that's for sure. If the stars align, as I said. But on the downside, you're still only paying for less than 10 times what it's currently producing. So even if it just stayed in the US and the international, maybe it would be a slightly more risky offering then. But we're talking about a company as well that's continually innovating and developing new products, spends a good amount on R&D each year to keep improving its offering. It's not a company that's just sitting still. So yeah, it's got a lot of the right kind of asymmetry, I would say, that you want to look for in an investment. So speaking of downsides, let's have a look at the risks. So the two primary risks Somero faces are a fall in demand due to an economic downturn and increased competition. I'll address both in turn. The company has been around since 1986 and has been publicly listed since 2006, which means it has survived several recessions, of which the most pertinent was the global financial crisis, the GFC, of 2008. In the financial data we studied earlier, we saw that revenues took a substantial hit in the years following the GFC, and net income turned negative for 3 years. There are a couple of notable points to be made here. Firstly, cash flows from operations remained positive in all years but 2009, where they were $1.2 million. Secondly, the company had a net debt position entering the crisis and was forced to refinance this debt, while the financial sector was decidedly risk off. On On the second point, this is far from the position the company is in today. It has a substantial net cash position and no debt at all if you exclude lease liabilities. In addition, it has $10 million of prearranged debt. It has a $10 million prearranged debt facility in place should it need to draw on it in a crisis of liquidity. These factors, combined with the increased scale of the company and growing presence in international markets, make it more resilient to a downturn than it was in 2008. I would consider it highly probable that the company could survive even a recession of GFC magnitude. Addressing the matter of competition, as I've discussed previously, there are already a couple of competitors in this space. Currently neither have the scale or product range to match Somero, but this doesn't mean they couldn't in the future. Somero will need to continue to grow and innovate in order to stay ahead of its competitors and prevent it losing market share. Thus far, the management has proven their willingness to do so in a measured way that maintains the financial resilience of the company. This process is likely to prove beneficial to shareholders and customers alike, as the product offering and cash flows of the company will both be improved. Something that could be considered a risk is the possibility of the company being acquired. As briefly mentioned above, the company's competitive advantages and relatively small size from a market capitalization perspective make it likely that any large company wishing to enter the sector may consider an acquisition the easier option when compared to building a competing business from scratch. Some may see this as an attractive possibility, as it would result in a quick gain, but for someone looking to hold the business for a long time and benefit from its potential growth, this wouldn't be a desirable outcome. So I'll just give, I've pretty much said this already, but let's just give the final conclusion I've listed here. So as stated at the top, the size of this highly profitable and growing US industrial company makes it too small for many institutional investors, which in turn creates an attractive opportunity for individuals. Adequate margin of safety is provided by a robust balance sheet with net cash and a PE of 7.1. The prospect of continued international growth, which would be internal as well, and a multiple re-rating offers the potential for outsized returns. So that was finishing up my write-up on it. So I just wanted to, so after I wrote that, we had a trading update. So I did a Twitter thread on this. So you can have a look at that on my Twitter profile if you want to read this one. Obviously the write-up was at firmreturns.com, so you can read that there. But yeah, let's look at the trading update. So I've said here, Somero Enterprises Inc. released a trading update for the financial year ended 31st of December 2022 today. So here are some highlights. Revenue is expected to come in at $134 million versus the previously forecast $138.8 million. So that was, just to fill you in, that was still up on the previous year, which is 133.3, but yeah, a little bit down from its forecast. This is predominantly due to supply chain issues in the US market that led to concrete shortages and disruption to construction projects. A similar drop in EBITDA to $46 million versus a forecast $47.7 million was also seen as a result. Cash at the end of the period was $34 million. On a positive note, trading in Europe increased by more than 20% and Australia nearly 40%. In 2021, these regions contributed $12.1 million and $6.1 million respectively. So we can estimate this year's figures to be somewhere around $14.5 million and $8.9 million. So yeah, we're seeing that international growth continuing as desired. Total revenue growth outside the US came to just under 20%, resulting in an international revenue contribution of 24% versus 20% last year. So that means the US has come down from 80% down to 76% of the revenue. So that's all looking positive. But obviously, part of that is due to the US market slowing down a little bit as well. but generally good to see we've still got a higher revenue than the previous year, but overall, but a higher revenue overall, but a more diversified geographical revenue mix. So and as I alluded to earlier, the 50,000 square foot facility expansion was completed in Q4 and is expected to be fully operational in Q1 2023. And it was all on budget. Outlook for 2023 is positive, with revenue and cash generation expected to be comparable to 2022. So one would hope that would mean you're going to have similar expectations for what they're going to offer for their supplementary dividend as well. So further investment is planned for this year to fuel future growth, and I've said all in all a pretty good result considering supply chain disruptions and inflationary pressures that have affected the construction industry this year. So I think there was also something about revenues in Europe being pushed back a little bit as well, so that the second half of maybe that was in the previous, but in my write-up, but there was some pushback of revenues because of delays in supply chain. So the company's done quite well with managing supply chain disruptions and other sort of issues, and still managed to, I think there's been able to increase revenues a little bit through price hikes matching inflation rather than perhaps greater unit volumes, but we don't have all that information yet, so just speculation at the moment. So yeah, that pretty much wraps up Somero. Like I say, you can check out the article on firmreturns.com, listed on the front page. You can find it, and then you've got you can also subscribe to get those ones. I'm trying to do at the moment sort of one write-up a month. So this one the last one came out around beginning of this month, so it'll be sort of beginning of next month. And I'm currently working on quite an interesting one. It's a net asset play, a UK pub and hotel chain called Fuller, Smith and Turner. Really quite interesting one. It's selling at they recently revalued the asset portfolio, so the estate of pubs and hotels, which had not previously been done since 1999, and the result was that it's added something like £400 million onto the book value of the company, which, considering the company is currently trading below the book value, that using the 1999 figures, puts it at something like, I think the current share price is about £5.30 a share, and the book value is estimated to be £13.76 or something crazy like that. So yeah, a pretty crazy discount to very tangible real estate book value. And reading through, I'm still working on reading through it at the moment, but it's quite an interesting play with in terms of it being, I think currently it's still owned majority by a family, by the Fuller, Smith and Turner families. So it's not something that you would expect to be bought out or something like that, and you expect them to be really managing it with the business's interests in mind, which is quite good. I'm just building up my picture on it yet, so I've not got a full thesis or anything, but yeah, I'm liking it so far. And so yeah, if you're interested in getting that in your inbox, so subscribe to the newsletter, and you should get that at the beginning of next month when I've finished writing it up. But anyway, that concludes the second episode, and I might do a couple more before I do that next write-up. Anyway, I've still got a couple of other before I release the next write-up that I just mentioned. I've also might do a podcast on Aviva, which is another one I've written up, and finally Taylor Maritime Investments, which are two quite different companies, so you're getting quite a diverse array of different businesses to explore. Anyway, until then, I'll say goodbye. Thanks for listening.